In today's video, we're gonna be breaking into life insurance 101 in Canada. So how does life insurance work in Canada? We're gonna go over quite a few different things in this video. So different terminologies, if the insurance company can deny your claims, what companies are in Canada, what different types of life insurance there is, term versus permanent, and a whole bunch of other things. So yeah, I'm excited to get into this video. Let's just get right into it. What's up, guys? For those of you who do not know me, my name is Philip Setter. I'm the founder and CEO of Affinity Life, which is an online life insurance brokerage here in Canada, where you can actually view quotes 100% online instantly, and you can actually apply 100% online as well. So if that sounds interesting to you, I will put the link in the description below. But without further ado, let's just get right into the video. So if you've been looking at obtaining life insurance here just recently, or maybe even the past little while, you've probably seen some different terminology thrown around that may be a little bit confusing to you. So I guess first thing I'd like to do when I start this video is I want to break down some terminology, because there's a lot of lingo that we use in the insurance industry that might be confusing. It might not be, but we'll just burn through them real quick, just so you kind of get an idea. If I start using these terms and you have no idea what they mean, I'll explain what they mean. So I guess I'm just gonna read off my list here. So policy, that's just a contract between yourself and the insurance company. So if you ever hear people say like, oh, I'll look at my policy, or, you know, this is the policy that I have, all that is the contract between yourself and the insurance company. Now, policyholder, that of course is the person that owns that contract, okay? So if you went out and you've got life insurance with an insurance company, you are the policyholder, meaning you own the contract between yourself, presumably yourself as the individual, and of course the insurance company. Now, you could be a policyholder on someone else's life. For example, maybe you owned life insurance on your partner, but you were the owner, you were the policyholder, but they were the insured. So you can do that actually in Canada. You can buy insurance on other people's lives if you wanted to. There would just need to be an insurable interest. Beneficiary is another common one. You probably heard this one before. Beneficiary is simply the individual or corporation or charity, actually. There's quite a few different types of beneficiaries that you can have that would be the recipient of the death benefit, which is the next thing on the list here. So the death benefit is, of course, just that face amount, or that amount that would be paid to the beneficiary. So you choose that amount when you apply for life insurance, and it could range anywhere from, let's say, $50,000 all the way up to, I mean, the sky's the limit. If you pay the insurance company enough money, they will take your money and they'll probably give you that amount. Of course, you need to justify that you need that much life insurance, but getting up to $5 or $10 million is, assuming that you can justify that you need that much, isn't that hard here in Canada. Now, one more thing that I want to talk about specifically for death benefit before we move on is, of course, the death benefit is tax-free here in Canada. Your beneficiary, once they receive that death benefit, they do not have to pay tax on that amount. And the last one is premium. So you may have heard that word before. Premium, all that is the monthly amount or yearly amount, depending on how you want to structure it, that you pay to the insurance company in exchange for that contract. So if you hear premium, that just means the cost every month. Okay, let's talk about denying a claim. Can the insurance company deny your claim? So this is a question I think that is most frequently asked from clients of mine, as they say, like, what happens if I do this? What happens if I do that? Can the insurance company deny my claim? Are they gonna try and find a loophole to not pay me? And let me set the record straight here, and I'll explain exactly how it works so you are crystal clear on whether they will pay or they won't pay, okay? So when you purchase a life insurance contract and you apply for it and they approve you and you get this new contract and now you're fully covered for life insurance, what happens is you have this 2-year contestability period. This is how it works, okay? Within the 2-year period, the first thing that they can deny a claim for is if you commit suicide within those first 2 years. So that's the first one. However, after that 2-year period, you would be covered for suicide. So the logic behind that is they want to try and put this in place so it's like a cooling off period for you. If for some reason you did get life insurance, maybe you were in a really bad financial situation, you thought, maybe I'll just get it and then I'll off myself, my family will be okay. And that's a terrible thing to say, of course. But the logic behind it is, after 2 years, that's gonna be a cooling off period. A lot of things can change in 2 years, and hopefully you won't be having those kind of thoughts after that 2-year period. Now, the other thing that they can deny a claim for is intentional fraud or misstatement on the application. And so what does that mean, okay? Well, I mentioned they have that 2-year contestability period. So within those 2 years, they have the ability to contest your contract whether you die or not, okay? So what does that mean? Well, you can say, let's say there's a question on the application where it says, have you ever been tested for cancer, okay? And you say, well, no, I've never been tested for cancer. And then they find out in that 2-year period after that you actually did go to Mexico and you saw a doctor in Mexico and you did get tested for cancer and you tested positive for cancer, you did have cancer at that point, you were diagnosed with it, well, they can come back and say, hey, you answered this question this way, but obviously you were lying on the application, you were not telling the truth on the application. So within that 2-year period, they can come back and they can say, no, we're gonna cancel your insurance, we're gonna return your premiums. Obviously, you didn't answer everything correctly, so we're just gonna cancel it. Now, after the 2-year period, which is what that 2-year contestability period that I mentioned, it changes. So they can't actually contest it. The only way they can deny it after that point is they have to prove intentional fraud. And that's a little bit different than misstatement on the application. Because misstatement on the application could be simply, I didn't understand the application, I thought it meant this, but I put this. That's misstatement on the application. Fraud is that I knew full well that I was lying on the application and I still went ahead and I did it. So that's a much harder thing to try and prove. So after that 2-year contestability period, that's where it becomes more and more difficult for the insurance company to deny your claim. Now, you will not run into any of these problems whatsoever as long as you just answer the questions truthfully, which I would highly recommend on the application. Don't lie on any insurance application and you'll be fine. That's it. Game over, end, cut scene. So yeah, those are the 2 main reasons why an insurance company can deny your claims. The last third one, I guess, that I'll throw in here, of course, there's a couple one. If you don't pay your insurance premiums and your insurance contract is canceled, of course, then it wouldn't be paid out. But one of the interesting ones we have here in Canada, which I think is a good rule, is something known as the Slayer rule. The Slayer rule is if you murder the life insured of an insurance contract where you are the beneficiary, they will not pay that out. So let me give you an example here. We have a husband and wife. The husband owns, let's say, $1 million face amount on the wife, and he's the beneficiary of it. If he murdered the wife to try and get that insurance money, the insurance company would not pay that insurance death benefit out to that individual. So that's called the Slayer rule. It's just a little fun extra here that we have in Canada. Okay, let's talk about life insurance companies here in Canada though, because everyone's kind of looking like, okay, well, which company is best here in Canada? Which one should I go to? So I'll explain a little bit how that works. In Canada, we have roughly 20 to 30 different insurance companies. So, you guys probably all know the major ones, Sun Life, Manulife, Equitable, RBC Life. There's about 30 in total. And so the way it works is you have agents that will work directly for an insurance company, and then you have brokers that will have access to all the different insurance companies. And so some agents work directly for one company. For example, there's Sun Life agents that just work for Sun Life. There's La Capitale agents that just work for La Capitale. There's combined agents that just work for combined insurance, okay? And that's what's known as a captive insurance agent. And they have access to just that one company's products. And then on the other side is brokers, so an insurance broker. And that's what Affinity Life is, by the way, is an insurance brokerage. So they have access to almost every company in Canada. Some of the companies that are captive, meaning that they have their own agents, will not give contracts out to brokers, but those are few and far between. And your best bet is to work with a broker so you can have access to all the different companies and all the different products to make sure that you're getting the best price here in Canada. Do you need life insurance? Well, that's a really good question. And there's a few things that I would ask, and you can ask yourself here when you're determining whether or not you need life insurance. And the easiest question to determine whether or not you need life insurance is, would there be loved ones within your life that would be financially impacted by you passing away? Okay, so let me give you an example here. We have a husband, a wife, a new family. They just had a new baby. They just moved into a new house. The husband, of course, he's working. The wife, she's working. Both of them would be financially impacted if one of them were to pass away. That's a really easy rule of thumb. If you were to pass away, would those in your life that are close to you be financially impacted by you passing away? Now, of course, you have some other things in there, such as maybe cost of funeral expenses, maybe debt that you're carrying, maybe other financial burdens, such as tax bills that are outstanding that you don't want to leave to your family. These are all things that would determine whether or not you need life insurance or not. Now, by the way, there is a needs analysis calculator, a recommendation quiz on our website, which you can actually take, and it'll tell you if you need life insurance or not. We can also let you know if you don't need life insurance, and that is built into that. So if that's interesting, again, the link is in the description. You can go and do that needs analysis and see if you do require life insurance or not. Okay, let's get into the different types of life insurance real quick. I've made lots of other videos on life insurance, and you can view those all on my channel. I'll put some links up here, but let's just get into the basics just so you can get a general idea. Now, there's some different ways you can structure it. One is known as single life, and all that means is that's on the life of just one individual. So if that individual passed away, then of course the life insurance would pay out. And this is the most common one. The other two that are a little bit less common are something known as joint first to die and joint last to die. Now, these are more used with something known as permanent life insurance, and I'm gonna get into that later in this video, but that would mean that you have that on the life of two individuals, such as maybe a husband and a wife. And in that case, joint first to die would be the first person to pass away, then it pays out, okay? Now, the other one, joint last to die, is of course exactly how it sounds. The last person to pass away, then that insurance payment would pay out. Now, you might be asking yourself, well, why would anyone do joint last to die or joint first to die, pardon me? Well, the reason is when the insurance company can base it on two different lives instead of one, the rates are more preferential. And if one individual had maybe some health concerns, it would be a little bit easier to get the life insurance on both lives, because now we're essentially underwriting it on two different individuals. So the insurance company is spreading out their risk. Okay, so let's talk about term life insurance first, and then we'll talk about permanent life insurance at the end. So term life insurance is easiest, the most simple to understand. I equate it exactly to renting a house. While you're renting the house, of course, it's really cheap to rent the house compared to owning the house. You can pick a term. So with life insurance term, you can also pick a term, hence the name term. You can do a 10-year, you can do a 20-year, you can do a 30-year, and those premiums are fixed in that time period. So if you pick a 10-year, they're the exact same for 10 years. If you do 20 years, they're the exact same for 20 years. Now, term life insurance is really used to cover you for a specific period of time. It's incredibly cheap compared to permanent life insurance, and it's really used for individuals that are just looking for a period of time, such as their kids are just growing up, you just bought a house, you maybe have some outstanding debt, and you want to cover yourself for maybe that 20 to 30 year period until the kids are out of the house, you're much closer to retirement, you have some savings in the bank, the house is almost paid off, or it is paid off, and you're in a much better financial position. And if you did pass away, those that depended on you wouldn't be as financially impacted. So term is the best way to cover that. Now, how term life insurance works within that term is, like I mentioned, you have those fixed premiums for whatever term you pick. However, at the end of that term, so let me give an example. Let's say it's a term 10. At the end of that term 10, you have I guess 3 different options really, okay? Option number 1 is you can cancel that insurance, go back on the market, and see if you can find a better rate. Option number 2 is the insurance company is contractually obligated to renew that term for you. So it could renew for another 10 years, and you have those rates built into the contract. However, the rates will jump up roughly about 3 times. So if you're paying, let's say $30 a month, then when it renews, it's gonna go up to, let's say, $90 a month, okay? Now, they're contractually obligated to give you this no matter what your health condition is in. So if you, let's say, had some adverse health conditions over that 10-year period, maybe cancer, maybe you had a heart attack, maybe you had a stroke, maybe diabetes or something like that, and you couldn't get other life insurance on the market, no problem. They have to renew it for those 10 years. The third option that you can do with most insurance companies here in Canada is convert it. So you can actually convert your term life insurance into a permanent life insurance contract. And so this works really well for maybe individuals that are in their, let's say, 50s or 60s. Now they're looking towards estate planning. Maybe they want to leave something behind, but maybe at that point they have some adverse health conditions. Well, no problem. You can convert it without a medical underwriting into a permanent life policy and then use that for your estate planning needs. And again, if you're looking for term life insurance, you can visit affinitylife.ca and get instant quotes and apply 100% online. I will put the link in the description below if you want to check that out. But let's get into permanent life insurance and explain how that works. So what happens if you get to the end of your term and you're getting, let's say you're getting a little bit older now, you're 40, you're 50, you're thinking, wow, I don't want to keep paying these premiums. Maybe I want to leave something behind to my children. I have a little bit extra cash and I'm now looking towards estate planning as opposed to just covering myself for a specific period of time. Well, that's when you start looking at a permanent life insurance option. Permanent life insurance is really meant to cover you until death. Term life insurance is only meant to cover you for a specific period of time. Permanent life insurance is meant to cover you until death. Now, there's two different types of permanent life insurance here in Canada. There's whole life and there's universal life. And I'll explain a little bit of them, but again, I've made other videos really breaking into the nitty-gritty of those. Whole life insurance will be more of a guaranteed option. So it'll be a little bit more expensive, but you'll have a guaranteed death benefit. You'll also have a guaranteed payment period, meaning that you can pick a payment period such as 10 years, 20 years, whatever it be, and you can pay it and then it's done being paid. You don't have to pay any more premiums, but you own that life insurance. Universal life, on the other hand, is a little bit cheaper. It's more flexible, but it doesn't have any guarantees. So you need to weigh the pros and cons of each. And again, I've made other videos of these and you can watch those and I'll put the link somewhere in this description or somewhere up here in the screen. But those are the two different types of permanent life insurance here in Canada. Now, permanent life insurance is much more expensive than term life insurance. It's gonna be 4 to 6 times more times the premium of term life insurance. So if term life insurance is, let's say, $50, chances are permanent is gonna be $250 or $300 for the same death benefit. So it is much more expensive. It shouldn't be used to cover you for that specific period of time. That's really what term is used for. Permanent is more used for estate planning needs and to cover you until death. Now, you may have heard people suggest using permanent life insurance as an investment. You may have heard this term before. You may have heard people say, invest in life insurance. You can use permanent life insurance as an investment. You can, allocate some of your income and put it towards there. That is a giant can of worms. And I made another video, which is a long video. It's like 45 minutes on whether or not life insurance is a good investment. And I'll put that video there somewhere. But in a nutshell, here's my opinion on it. Life insurance used as an investment is not a good idea for the vast majority of Canadians. It can be a very good idea for very specific people. And usually those people are high income earners or high income business owners that have a lot of revenue. They have disposable cash. They've maxed out their RRSP. They've maxed out their TFSA. They have other accounts, big non-registered accounts, and they're looking for some type of alternative investment. Well, in that case, it could be a good idea, but for the vast amount of Canadians, it's not a good idea. So who is permanent life insurance right for? Well, again, I kind of mentioned that, but it's people looking towards estate planning. They want to pay off some taxes at death, possibly, leave something behind for maybe their children, leave something behind for their grandchildren, maybe leave something to charity. Maybe there's a disabled child that they want to make sure that they take care of as well. But it's really leaving something behind for the next generation. It's not used for a specific period of time. It's used for as a guarantee, this will pay out. Until the day I die, it will pay out. And it's really to leave some behind for the next generation and to help with estate planning. So with that being said, I think that's all I can say in this video, Life Insurance 101 in Canada. I hope you guys enjoyed this video. And if you guys have any questions, just put them in the comments below or feel free to book a call with me on my website at affinitylife.ca. And if you guys are enjoying this content, all I ask is that you give it a thumbs up and I'll see you guys in the next video.